Welcome to Inside Network's INBrief at the Income and Defensive Asset Symposium. My guest today is Craig Bannister from Pallas Capital. Welcome, Craig.
Very good to be here.
Tell us a bit about Pallas Capital.
Well, Pallas started in 2016. Started off as a development company under the Fortis Development Group brand. And then at the same time, we looked at the market, and our CIO, Dan Gallen, said, let's get into the non-bank lending sector as well. And so we started off two separate business streams under the Pallas Group. Fortis Development Group, which is now 28 projects across Sydney and Melbourne, focusing on luxury downsizer residential markets and commercial boutique office space in South Melbourne and Double Bay up in Sydney are the two sort of hubs there. And then Pallas Capital, the lender, started at the same time.
Yes.
And built up from a base of high net worth investors. And today we sit at $2 billion, having lent out across that time. About 700 million of that loan has been returned, loans matured, and we sit with about a FUM of about 1.3 billion.
Yeah, fantastic. What differentiates Pallas from other lenders?
Yeah, well, the non-bank sector, the continuum of non-banks from probably low risk blue chip lending up to sort of higher risk lending, you might say, under first mortgage. We tend to sit in a low risk area, inner city development lending.
Yep.
We stay away from on Globo land out west, so we've been very tight, and really the DNA mirrors that of Fortis Development Group, where Fortis has been developing eastern suburbs, Sydney, Melbourne, and that boutique inner sort of ring. We've matched that as a lender. So our lending locations have been very much inner city, Sydney, Melbourne, and then the other big differentiating factor, us as a non-bank lender, we have a development company on the other side of the business, and that's quite unique. So the insights that we get from that side of the business with 45 development managers, and for the credit team over on the lending side, it gives us some great insights into, would we as an asset owner be lending to that site, development, location, type of product. So
absolutely. DD must be a lot easier.
Yeah.
And you're still relatively
We're sort of on both sides of the fence.
Yeah. Young business, and young business, lots of different economic environments, and sometimes, not saying, but loans could go bad. So the ability to do something with that loan or the site must be a real advantage for your unit holders versus someone else that doesn't have that development capability and experience.
Yeah, you're right. At a worst case scenario, should that loan that we've made to a third party developer go into a default or impairment stage, we could, if necessary, bring in-house development capability through Fortis and see that loan out through to completion. So it's quite unique, rather than going through a fire sale and having to sell the property. So
my day job is a financial planner, and as a financial planner, I have to explain your product to my client. So if I'm going to give an example to my client about the type of investments that they will be exposed to in your fund within Pallas, what would be a good example?
Well, there's probably three buckets, I'd say, and we've got single asset loan opportunities and diversified funds, which are warehouses with single assets inside. But on the single asset opportunities, three different types of lending that we do: pre-development land loans, 12-month loan term, so short duration, on inner city infill sites, lending at 65 LVR against as-is valuation.
Yes.
Moving through the planning stage, once that developer has got planning approval, then we're into a construction loan, an 18-month construction loan.
Yes. And
then at the back end of that, if unsold stock remains, then we do a residual stock loan. So we could be doing 3 loans to the one developer over a 3-year time frame. So you, with clients looking at various risk parameters, you're sort of resetting your risk every the end of each loan. 12-month loan term on pre-development gets reset, refinanced with a construction loan, 18-month, and then gets reset and repaid out with either pre-sales or a residual stock loan.
Yeah, it's a fascinating asset class that is more well known globally for its risk-reward characteristics. It is growing in Australia. It seems like private investors have clued in first in terms of the opportunity set, and it's filtering into the wealth management space.
Yeah, well, I think we've got a long way to go in terms of looking at it from where Europe sits and the States. We are, we talk about the commercial real estate debt market in Australia being 400 odd billion.
Yes.
The big four banks controlling 90% of that, and the non-bank sector 10%. Now, the growth in those markets are, the commercial real estate debt market's growing at 5%. The non-bank sector's probably growing at 10 to 15%. So the sector's growing, but the non-banks are growing and taking market share away from the big four banks.
Sure.
Still
a big opportunity.
And the big opportunity is when we look at Europe, non-banks are funding almost 50%, and the States are into 60%. So we've got a long way to go for non-banks to come in and fund it. And we're getting funding from all sorts of different, not just. I think the evolution of the sector is initially it was high net worth investors and family offices coming in and supporting non-banks.
Yes.
Now we've got institutional partners coming in and backing the non-banks, and we're a benefit of that. Under Credit Suisse, we've got Credit Suisse as an institutional funding partner for a particular fund.
Again, it comes back to that risk-return characteristics.
Yeah.
If it's attractive, all pools of capital will be attracted to it.
Correct.
So, I think there's a question here about how should your advisors allocate, but that might have been answered by other presenters talking about how you roll fixed income portfolios and the role of private lending. So, do you have any comments around?
Yeah, it's we tend to sit in that alternate asset class, fixed income. We are steady backed returns backed by real estate under mortgage securities, personal guarantees, company guarantees. So you've got a good tripartite arrangement with security arrangements over each loan. Where that sits in investors' portfolio, it's clearly a fixed income type product.
Sure.
But I think it has different characteristics than the bond markets, with the security, the underlying security being mortgage-backed property.
And any concerns about what's happened in the last 6 to 9 months where rates have jumped up substantially?
Yeah, in the sector where we're lending out to, so the variable rates you might be calling it, and the rate. The market's resetting into variable rate lending this year. That's coming off from a very low base, whereas the initial lending rate to a borrower from us might be 7 or 8%, and then you're adding on the margin from RBA that's gone up from 0.1 to 1 to 2 to 3. Now that, if you take a developer's project financing costs, they're generally about 7 to 9% of the total development project. So it's a small part, and when you then add a variable rate increase, it's not a huge. Our bigger concern is probably what's happening with construction costs, and then potentially end values. How does that affect a feasibility study? Rather than, I think the commercial borrowers can easily absorb a 3% rise in variable rates.
More about the risk-free rate and the cost of building versus a couple of percentage points on the rate. Yeah, great one. Thanks, Craig. Thanks for joining us.
Great. Thank you very much.
Cheers.
Cheers.